money. Welcome to Cramerica. By the way, friends, I'm just trying to save a little bit of money. My job is not just to entertain, but to put it in context. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. In this corner, weighing in at $4.27 trillion is the reigning champ, Nvidia. In the other corner, coming in at around $86,000 is the challenger, Bitcoin. At stake is nothing more than the stock market itself, and we don't know which will win. If Nvidia triumphs in this high-stakes contest, we'll probably go higher. If Bitcoin keeps going down, the stock market's definitely headed lower, which might sound ridiculous, but it's the truth. The prize fight is dominated a session where the so-called regular growth stocks look strong, but the speculative stocks looked atrocious. Dow sinking 427 points, S&P declining 0.53%, NASDAQ just shedding 0.38%, a little stronger than it was looking very early this morning. Now, given that everything was down when I came in today, and nothing major turned up until Nvidia unveiled an important initiative with Synopsis, an electronic design automation company, I think it is safe to pin any upside that happened in this market today from the good news from Nvidia, which, by the way, rallied $2.92. That kind of rally from the world's biggest stock is very important to the overall market. But I want you to understand that Bitcoin has a peculiar, almost unknown hold. Maybe I should say chokehold on much of the market, because as I painstakingly detailed in this weekend's Investing Club Think piece, if you add up all the crypto derivatives, it makes up a surprisingly substantial chunk of the entire stock market. Unlike equities, there's a bet the farm aspect of crypto that threatens the averages every time Bitcoin sells off, like it's doing now. Of course, crypto comes in many forms. There are those who hold it as a store of value against economic catastrophe, especially in the form of debased currency. There are those who think it can be used as a currency itself, if not now, then perhaps in the future. There are investors, many of whom have made fortunes until recently. And then there are the speculators who borrow money to buy crypto simply because they believe it's headed higher. Here I'm thinking mainly of a company, an actual company called Strategy, formerly MicroStrategy, that simply become a leverage bet on Bitcoin itself. Michael Saylor, frequent guest on Squawk Box and also the CEO of Strategy, is a true believer to the point where he's been willing to take more than $8 billion in debt to buy additional Bitcoin. Hey, look, that's terrific position when Bitcoin's going up, but it's a disaster when Bitcoin's going down. There's always a contingent in the market who views Saylor as a wannabe Humpty Dumpty. They're just wondering if this fall means all the crypto's horses and all the crypto's men won't be able to put Strategy together again. The incredible tentacles of Bitcoin stretch into so many different areas, obviously anything crypto mine, but also like quantum computing, uranium, alternative data center energy, even flying cars that may never pass FA muster. These groups tend to all go down at once, linked by speculative fervor and what's essentially volatile bets on the far-out future. It's all rag. And taken together, it's dangerous to the market's health. My biggest fear, my nagging nightmare. And it's ignored by Wall Street. I think in part because the whole complex generated huge fees, and the industry never met a fee it didn't like. Now let's talk about the force of light. Nvidia. Something's been nagging Nvidia ever since the stock touched $212 at the end of October. Despite the company's unassailable long-term record, the what have you done for me lately crowd has turned on this stock, hitting and booing it early this morning, even as it flirted with $172. Now, I could regale you with the slings and arrows aimed at Nvidia stock, but let's just deal with the current imbroglio. Nvidia was thought to have almost the entire AI semiconductor market to itself not that long ago, but lately we've seen Nvidia become a punching bag. First, AMD unveiled a competitive chip, one that was adopted by OpenAI not long after Nvidia said it would invest billions in that company, and received a gigantic order for semiconductors itself. Then Google announced that it was going to expand the production of its own chips, which had always been presumed to be in some sort of in-house afterthought, until it showed the world how terrific they were. Then they leapfrogged into an order from mega Nvidia client Meta to Google. To even think that Meta would team up with arch rival Google on anything would be difficult to imagine. But to pay Google rather than Nvidia in order to bring costs down? It's a travesty. And don't forget, then there's Gemini 3, another reason to be able to want something that Google has. All on top of that, our government's saying that China remains a no-fly zone for Nvidia's best chips, even though I'd argue that in our national interest to get China addicted to Nvidia's semiconductors. But they call me a globalist. Next thing you know, monopoly with gigantic Chinese profits looks more like it's a China-less, unhappy oligopolist, which means the end of Nvidia's big profit margins and the beginning of its lion and winter scenario. Since then, the stock's been just a complete nightmare. Sometimes I feel like they should change the symbol from NVDA to DNR, meaning do not resuscitate. Until today. Today, when Nvidia announced an expanded partnership with Synopsis, a company that helps to automate the process of chip development. Synopsis received $2 billion from Nvidia as an investment to cement the relationship. Take a listen to what CEO Jensen Huang told us this morning on Squawk on the Street.
This is a huge deal. The partnership we're announcing today is about revolutionizing one of the most compute-intensive industries in the world, design and engineering.
Jensen on offense. Now, this partnership marries NVIDIA's lightning-fast chips with the tools of Synopsis to create simulations at speed and scale that Jensen said was previously unimaginable. The hope here is that anything involved in the manufacturing of any large product can be automated, revolutionizing the way things are built. Do you know what this means? It means attacking a $40 trillion construction industry and making it much easier, simpler, less wasteful, and of course cheaper to build any large project, from gigantic bulk carriers to aircraft carriers. For example, let's say, this is just an example. Boeing spent $15 billion developing the 787 Dreamliner, which translates to around $25 billion in today's market. Gotta believe a big chunk of that went to prototyping, something that this technology could allow them to do digitally for much less money. It's more likely that new and old companies would begin to build manufacturing plants that are much less expensive and therefore increase the rate of success. It could be just a productivity enhancer maybe we've never seen. This announcement did two things. One, it tells you that there's going to be a replacement cycle of immense proportions since everything's built around much slower CPUs versus NVIDIA's GPUs. And two, that whatever you may think of that hyperscaler horse race to build out chatbots that we all know, that may not be as important now that this announcement has come out. Or to put it another way, there's certainly a lot riding on Google's chips and what they might mean to NVIDIA, as well as any possible slowdown in OpenAI's growth. If Google's Gemini 3 picks up steam and OpenAI, a closer affiliate to NVIDIA, falters, it could be nasty. However, in the end, that's a business-to-consumer strategy. And the stock market has historically found business-to-consumer fickle, hard to game, not worth as much. But NVIDIA's work with Synopsis, while almost invisible to you, the consumer, has much more potential to actually make a lot of money. Wall Street, you see, loves business to business. This is business to business. Will this Synopsis deal stem the selling in NVIDIA stock? Oh, it's hard to tell, given that we could get a data point tomorrow. It's so critical of the big data center build out that it takes everything down. Still, though, this deal matters. It wasn't for show. It was for substance, business to business, and it turned at least that stock around today. The bottom line, I never like to say, well, it's anybody's guess. I would say, however, that it seems like the speculators are going to have their hands full with Humpty Bitcoin. But the NVIDIA backers just got a second win that could be meaningful for more than just one day's action. Let's go to Jerry in Missouri. Jerry.
Jim, thanks for taking my call.
Of course, sure. What's happening?
Jim, you talked about this stock many times and written about it in your new book, but wow, does its price swing a lot. So my question is this: should I just hang on, or is it a good stock to trade around a core position? And if so, can you give some parameters for that trade? And I'm talking about Reddit.
Okay, I am not going to recommend that you trade around this. I'll tell you why. It's at $42 billion. I think this company has within it more quality things to train on More quality ideas, more quality writing than people realize. It's incredibly undervalued. Steve Huffman should come on the show. We would go over many of the different sectors. I go into Reddit constantly. I don't know about you. I think it's worth a heck of a lot more than it's selling for. Let's go to John in Arkansas. John.
Booyah, Mr. Cramerica.
Oh, booyah, right back at you, John. What's going on?
I don't want to get too far in the weeds, but I'm curious about McDonald's stock price and the dividend with respect to commodities. You know, we had mad cow, avian flu, swine flu, fuel shortages. Just your thoughts on that, sir. I appreciate what you do, and you are Mr. Cramerica.
Okay, here's how I think about that. There's two ways I want to look at it. I don't know if you're on the app of McDonald's or you get the deals. Every day they come at you with something that is just a doorbuster idea. Secondly, I think cattle's peaked. I think it was a generational high, and it's coming down. And that to me says bye the stock of McDonald's. And thank you for the call, Bill in Massachusetts. Bill.
Jimmy, I love how simple the club and you and your staff make it for us people that aren't college educated. I want you to understand how much this means to us, guys. You give us the information we need. You interview all these incredible CEOs. It's just, you must have an amazing life. I really enjoy
I have a fantastic staff. First of all, great staff. But second, I love what I do. And what I do is try to help people like you feel like that you got a shot. There's so many people in this country who feel you don't have a shot. And that's, you know why that is? They want your fees. They want your money. Mm-hmm. I don't want anything. Okay, I wrote a book. Okay, so I want that. No, I got it advanced. It's like, it doesn't work. Let's put it this way. I didn't do it for the price of the book. I did it because I want to help you.
Amazing. You're an amazing person, Jim.
Thank you, buddy. Thank you. How can I help today?
You know me, Boston Bill. I'm your friend of the club. I love what you guys stand for, really American values, which I really enjoy. Tonight, I'd like you to go over a little bit. There was a little incident with CME, with Vertiv Holdings and their cooling system. Could you go over, enlighten me a little more about what happened there and how if it will or how it could affect Vertiv?
Well, I think Vertiv actually opened down today because people felt that they were somehow involved with what happened with CyrusOne. All I know about Vertiv is their order book is really full. You need Vertiv. That's Liebert. That's the best cooling system. Everybody knows. I first started buying Liebert in the 1980s, and that was the highest, best form of air conditioning. That's what Vertiv is. That's why everybody loves it. And by the way, I think it's a buy right here. And Bill, thank you for saying those things. You just go over, you have a holiday, your family, they're all asking you when you're done. How about, I said, when do you begin? The Synopsis deal really matters. It has substance, and it turned the stock of Nvidia around today. Nvidia backers just got a second win, and it was needed. On Mad Money tonight, the data center stocks have been joined at the hip into one key catalyst that has changed the way these stocks are trading. I'm going to reveal what it is and how you can survey the space now. Then we heard from letter A, Agilent, last week, and things are looking brighter in the life sciences industry at last. I'm showing you what stocks you should be looking at because I think the outlook just got a lot rosier. And you called in and you stumped me on 4 different stocks. Oh no! So we're having a rapid fire homework segment and I'm running through all the names I didn't know what you asked me, and some of them, no, one of them is real good. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
For the past few years, virtually every stock connected to AI and the data center has been joined at the hip, and they steadily march higher together. But last month, that changed. Over the past 2 weeks, it's become very obvious that Google's Gemini 3 is now the best of the chatbots, surpassing OpenAI's ChatGPT. I know, I've totally forsworn ChatGPT for Gemini 3. I just find it more comprehensive and better, let's say, at interpreting things. The Gemini 3 improvement was very good news for Google and all the stocks connected to the AI efforts, but it also caused everything connected to OpenAI to get whacked. Didn't help that we've been hearing more and more worries about OpenAI's lavish spending commitments. I mean, come on, this is a company with $20 billion annual revenue run rate. It's going to exit with that. It might be on the hook for $1.4 trillion. So Google stock soared, as did Broadcom, which helped make the custom processors that were used to train Gemini 3. Hey, same goes Celestica. Remember that one, CLS, the contract manufacturer? And a couple similar networking equipment vendors we don't talk much about, Lumentum, TTM Technologies. At the same time, what we're calling the OpenAI complex got hit. And that's Nvidia, Oracle, AMD, Microsoft, along with the data center operator CoreWeave, and SoftBank, the Japanese investment firm. The Google complex and the OpenAI complex used to trade together, but now they started moving in opposite directions. The 5 stocks in the Google complex were all flat or positive in November, up nearly 18% on average, while the 6 names in this OpenAI complex, they were all in the red. They were down an average of 23%. At the same time, we're starting to see another parallel contingent of haves and have-nots. This one's the hyperscalers that have good balance sheets, the hyperscalers that have not good balance sheets. Now, these are companies that have poured tens of even hundreds of billions of dollars into data centers. Think Alphabet, Microsoft, Amazon, Meta, Oracle, and some private firms like OpenAI itself and Elon Musk's XAI. On a smaller scale, we're seeing something similar with the smaller data center operators like CoreWeave, Nebius. On Friday, a sales desk note circulated by Tony Pasquarella. He's the global head of hedge fund coverage at Goldman Sachs. It broke down the 2 groups. He says that Alphabet, Meta, Microsoft, and Amazon clearly have the capacity to keep spending like crazy on AI, while Oracle, CoreWeave, and Nebius, well, they got balance sheets that are much more strained. Pasquarello points out that the outfits with stronger balance sheets have started performing much better than the ones with weaker balance sheets. We ran the numbers ourselves. The former group was up an average of 1% last month, while the balance sheet have-nots were down nearly 32% on average. I mean, it's pretty obvious that's the fulcrum. Hey, speaking of balance sheets, now that Wall Street's getting worried about all the data center spending, Apple's starting to look real smart for sitting on its hands the whole time. They were criticized for that. I don't know about that anymore. Like I've been saying, why should they shell out billions to build out all this infrastructure when any of the generative AI companies would happily pay them tens of billions to be the default chatbot for Apple's ecosystem? Apple's up over 3% in November. It's up over 13% year to date. Big multiple expansion. Now, if I were managing one of these chatbots, I was up against Gemini 3, I would be running to Apple with my checkbook in hand, hoping they would let me pay them to be the default AI site. But I think only Gemini 3 right now would rank as acceptable to Cupertino. So what do we make of this data center divergence? First, in general, I think it's pretty healthy. I'm never going to root against higher stock prices. You may own one of these stocks, but there was always something unsettling about the entire AI cohort rallying in lockstep. Now that the investors are starting to think a little more critically about which of these companies deserves to be winners, I consider that a good sign. Stock picking matters again. At the same time, I need to warn you about chasing these ideas. If you want to buy the Google complex names I just mentioned, you're probably a bit late. The gains from Gemini 3 already seem to be baked in. Quite a move. More importantly, last month showed us how quickly things can change in the AI space. While Gemini 3 has suddenly become the top dog in generative AI, it's possible that one of the other contenders can make a breakthrough and leapfrog them, just like they leapfrog ChatGPT. Hey, just today we learned there's this private AI company I've never heard of. It's called Runway. Has created a new AI video model that's supposed to be better than anything on the market. And who knows what ChatGPT 6 will look like? I mean, I'll check it out when it comes out. Maybe with the help of new GPUs from Nvidia, it'll be even more impressive than Gemini 3. And the moves we saw last month will have to reverse, or at least moderate a bit. Long story short, if you want to keep betting on the data center, you need to be more alert to what's happening in the industry and more selective with your stock picking. Finally, let's be careful not to paint with too broad a brush here. For example, Nvidia got clobbered last month on worries about newfound competition. Remember, it's also part of the so-called OpenAI complex. But let's not forget that Nvidia just reported a blowout set of numbers less than 2 weeks ago with excellent guidance for the current quarter. And broader market dynamics notwithstanding, Nvidia is still essentially sold out for its latest generation chips. Demand for these things will far exceed supply. And don't forget what happened today when they announced the deal with Synopsis. Until everything changes or until the company stops being the industry standard bearer for AI developers, I got a real hard time getting too negative on Jensen Huang's company. You know that. Once again, I say own Nvidia, don't trade it. That is my takeaway. That said, I am concerned that OpenAI feels like a big unsolved mystery. Until we get some kind of resolution about their status, either a clear indication that they'll be good for the money they're committed to spend, or worse, a clear indication that they're not good for it, then we're going to see volatility for the stocks of companies that are most clearly linked and closely linked to them. Unfortunately, that does include Nvidia, which doesn't necessarily need OpenAI, but it's on track to receive several $100 billion worth of revenue from them, either directly or indirectly, over the next several years. That's assuming OpenAI can raise money to pay its bills. Maybe it has to come public and borrow even more money. I don't know. So here's the bottom line. Last month, the AI data center stocks finally started trading independently. The Google complex cohort roared, while the OpenAI complex got hammered. Meanwhile, the hyperscalers with great balance sheets held it much better than the ones with strained balance sheets. Just keep in mind that things change very fast in the AI space. So what was true last month might not necessarily stay true this month or next year. That said, it's hard to go wrong betting on the companies with superior balance sheets. As for ChatGPT versus Gemini versus everyone else, that can change in a heartbeat. Net Money's back after the break.
Coming up, there's always a bull market somewhere, and Cramer's revealing an under-the-radar sector that's been showing strong signs of life. Next.
Last week, just before Thanksgiving, I got the chance to speak with Agilent Technologies. That's an arms dealer to the life sciences industry. A long time ago, this stock, known as letter A for its stock symbol, was a great growth vehicle. In the decade before COVID, Agilent's chart was just a thing of beauty. Then when the pandemic got rolling, the stock grew even higher. But ever since the pandemic receded, things got choppy for this one. But also for the entire industry. The life sciences companies had all the equipment they needed, so the whole group spent years in the doghouse. Lately, though, the things just caught fire. Agilent's now up more than 55% from its April lows, and that interview with CEO Padraig McDonnell on our show was very encouraging. The company had just reported a very solid quarter last Monday night with a 7% organic growth, and he made me feel like the business is really turning around. Now, some of that's company specific, but some of it's industry wide. McDonnell explained that they're seeing a big push for reshoring in life sciences manufacturing, a federal initiative, along with the rise of novel types of medicine that require more hardware to produce. At the same time, the Trump FDA turns out to be a lot less disruptive than many on Wall Street expected, even with RFK Jr. at the helm at Health and Human Services. That got me thinking, maybe it's time to circle back to the rest of the group. I used to recommend these arms dealers to the life sciences cohort pretty regularly to you, but then after they went out of style at the Wall Street fashion show, But if Agilent's turning around, then the same should be true for its compadres. That's why tonight I'm going to walk you through the best players in the industry. Now, first, there's tried and true, but lately trying, Danaher, DHR, conglomerate that became more focused on life sciences and diagnostics when it spun off its water and product quality testing business as Veralto a couple years ago. We own Danaher for the Travel Trust, so I got to tell you, it's been really frustrating for the past couple years, even though we bought it during the post-COVID washout. Turns out that was early, as the stock languished for a very long time. Lately, though, Danaher's been acting much better. It's up 31% from its April lows. It's up 25% from its more recent low in September. Now, get this. In late October, in the middle of the stock's most recent rally, Danaher reported a strong quarter driven by solid growth numbers from the company's crucial bioprocessing division, which had been so languishing. They posted a small revenue beat with a solid 3% organic growth, as well as large earnings beat. While management really reiterated their full-year sales and earnings forecast, that was enough to get the stock. I told you it's been in just a hellhole. Get the stock moving higher. Looking ahead, Wall Street expects Danaher to put up its best growth in years in 2026. Mid-single-digit revenue growth and high single-digit earnings growth. If they can hit those targets, I bet the stock keeps running. I still like the stock for the Travel Trust, but we bought some stock real low in this one, and I'm thinking of trimming it if the stock jumps another 10 points. But 10 could be a lot. Next, there's the biggest player in the group, and that's Thermo Fisher Scientific, which does a bit of everything, selling big-ticket equipment, consumables, and services to companies all across the life sciences industry. With a new focus on clinical research services, followed by that's because of an acquisition they made called PPD a few years ago. Thermo Fisher experienced one of the biggest declines in the group earlier this year, but its stock had a strong recovery since then. It is currently up more than 50% from its mid-June lows. You know, I feel particularly good about this Thermo Fisher because, well, I got to speak with the CEO, Mark Casper, in late October. He told an excellent story. This was right after the company reported a good quarter, a healthy top and bottom line beat, with management raising their full-year forecast. Casper told us about strength across his businesses. Not only are his commercial and end markets doing great, but even previously tough areas like academia, which really shocked me given the way the government's been, government itself, and China, which has been terrible, were solid and growing again. Casper also called out the reshoring theme that Agilent mentioned last time. At the same time, Thermo Fisher is also partnering with OpenAI to create new tools and technologies that the company hopes will help speed up the drug development process. A real-world use for AI that goes beyond cost savings. Plus, some of the acquisitions Thermo Fisher made recently, they're starting to pay off. The company actually announced another deal a few days after that interview. They're paying nearly $9 billion to buy a company called Clario Holdings, which will give them even more exposure to the clinical trial ecosystem. Putting it all together, Thermo Fisher feels like it's back to being the company that I loved for so many years. I'm talking about since the show began. They're talking less about some inventory glut somewhere and more about the exciting technologies they're creating. It is such a pleasure to listen to that company now. Now, I've got two more smaller life science arms dealers to round out things. First one's called Revvity. You might have seen that one trade. That's the life science business that remained when Perkin-Elmer broke itself up about 2.5 years ago. Perkin-Elmer sold its applied food and enterprise services business to a private equity firm, and that business took the Perkin-Elmer name with it. The remaining life sciences business, which remained publicly traded, was renamed Revvity. Now, after a couple of years of disappointing results where the stock went nowhere, Revvity finally posted some better than expected numbers in October, and management raised their full-year earnings forecast. It was a good, solid result from a company that hasn't really given us much in those recent years, and the stock's gotten some traction since then. Revvity's the cheapest in the group, with the stock selling for around 21 times this year's earnings estimates. Finally, please don't forget about one that was always my personal favorite, never owned it for the trust, Waters Corporation, one of the quieter companies in this space that specializes in liquid chromatography and mass spectrometry. Now, that's stuff that you need to be able to do all this life science things. For much of the past few years, Waters was holding up much better than the rest of the industry, but the stock got hit real hard earlier this year, in part because the company announced a complex deal to merge with Becton Dickinson's biosciences and diagnostics business back in July. The market didn't like the deal initially, and Waters saw its stock plunge. It was so hard to understand. Things didn't turn around, though. Now the stock's up about 45% from its August lows. Now, some of that's because Waters arguably reported the best quarter in the group about a month ago. Revenue up 8% on a constant currency basis, along with a healthy earnings beat. Management also gave a nice boost to their full-year forecast. Now, Waters is still tricky because of that Becton Dickinson Biosciences deal. It's expected to close the first quarter of next year, but once that happens, I think it's going to be a much, much bigger player, and really, I think it's going to be loved on Wall Street. Here's the bottom line. If Agilent's turning around, then I have to believe the arms dealers in the life sciences industry can keep making a comeback. Now, that includes Danaher, Thermo Fisher, Revvity, and Waters Corp. Check them out. I think they're all worth a closer look. Let's go to Bob in Tennessee. Bob.
Jim, thanks for the call.
Sure.
I really have enjoyed your audiobook. Thanks for doing that.
Thank you. Boy, that took forever, but I got it right. People should get the audiobook. It's a lot more fun.
It is. Pfizer, is there any growth potential in 2026, or is it a straight dividend play?
2026, yeah, there is. They got a lot of irons in the fire. I think Dr. Borla is going to trace things out in January at the JP Morgan conference. I think you might like what you hear. So 6.8% yield. Until then, I would hold on to it. I would hold on to it. Let's go to Sam in Pennsylvania. Sam.
Jim, how are you?
I'm good, Sam. What's up?
Good. So, Jim, healthcare has had a lot of relative outperformance, and one of the companies in that sector I've been keeping an eye on is Regeneron. Stock is up 54% from its low this summer, so I'm curious if you think Regeneron can keep up the momentum.
Yes, down 30 today. Well, that's a bit. Well, it's a $750 stock. Now, let me just tell you something. Regeneron's move has been quiet, but Len Schleifer has been telling me stay focused on what they're doing. They're doing a lot of good stuff. I lost sight of it. I shouldn't have. This one and Amgen bothered me. They happened without me, and that was my bad, and I'm glad you brought it to our attention. All right, I have to believe the dealers to the life sciences industry are making a comeback. So if I were you, I'd check out Danaher, DHR, Thermo Fisher, Revvity, and Waters Corporation. Now, there's much more made money in from Enersys to ThreadUp. If you call in and you stump me on a stock, I always promise to revisit the story and give you my take. Tonight, we're doing just that. Then I'm in the unique position of not only being a dollar sign represented by a man, but also a journalist. I'm sharing how the current reporting cycle has chokehold over this market, and I don't like it. It was talked about all day, so it's a little contrarian view coming up. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Whenever I get a call about a company that I either don't know or haven't been following lately, I always do some research and circle back to it. Now that we're back from Thanksgiving, I've got a lot of homework to catch up on. Back in late October, Steve in Arizona wanted to know about a company called SEALSQ. That's LAES for you home gamers. SEALSQ was spun out of a Swiss cybersecurity company named WiseKey about 2.5 years ago. And it built itself as a quantum computing-oriented cybersecurity play. Basically, they've worked on technology that can protect you many years in the future when hackers have access to incredibly powerful quantum computing. Now, while there was a lot of interest in the stock at the time of the spin-off in May of 2023, that quickly fizzled. Stock falling almost 99% from its high in 2023 to its penny stock low in August of last year. 12 months ago, SEALSQ had a market capitalization of just over $10 million. Hey, but over the past year, the stock's caught fire along with the rest of the quantum cohort. Even though it's totally unprofitable and it's only on track to bring in $18 million in revenue this year. But now it's got a market cap of $733 million. In other words, this was a year of magical investing stock. And as I've said before, the year of magical investing is over. No, thank you. Next up, also in late October, Jeff in California asked about ThreadUp, which is an online consignment store and one of the world's largest resale platforms for apparel, shoes, and accessories. This one came public during the pandemic era bull market in early 2021, but its stock plunged 98% from its 2021 highs to its lows 13 months ago. Similar trajectory to the real. Now, it seems these stocks are hot again, at least the ones that are left. ThreadUp's rallied over 300% in the past year. Stock started running late last year, just after the election, which makes me think people were betting on it as a tariff play. The tariffs make new stuff more expensive, which makes resale products more enticing. ThreadUp's certainly moving in the right direction. After a down year in 2024, revenue's growing again, and they're on track to put up 19% growth this year. Their EBITDA has turned positive, too. That said, the company's still overall losing money. And it's not expected to become profitable until 2028. Given its $928 million market capitalization, I don't feel comfortable recommending this one, as it's never turned a profit since coming public. Sadly, this whole industry just, might not be that good. If you feel compelled to bet on something in this space, and trust me, you really don't have to, then I pick Etsy, the Depop parent. Of course, Etsy's not particularly doing well either, but at least they're making money. And the stock's relatively cheap at 14 times this year's earnings estimates. It's just better than ThreadUp. Next, in early November, Jim in Florida asked about another consumer-facing name. This was Dave & Buster's. Now, this one I actually knew, but I wanted to do more research to see if there was an opportunity here to come. It was public, then went private, then came public. Dave & Buster's stock has been struggling of late, and Jim in Florida is wondering if maybe due for a kind of a Macy's-style comeback. Still, the numbers are not so hot. Dave & Buster's looks set to get its third straight year of negative same-store sales and its second consecutive year of declining earnings per share. The company's been doing so poorly that around this time last year, their CEO had to resign. After several months with an interim CEO, the board brought in an executive from Yum Brands, Tarun Lal, who's rolled out a bunch of initiatives to turn things around, bring back TV ads, changing the menu, decreasing promotions. But it's still too soon to tell if this stuff is working. We'll have a better idea when Dave & Buster's reports it just next week. Here's what I'll say. For Jim in Florida, listen, I'm intrigued by the idea of Dave & Buster's turnaround, but with many consumers struggling and the company itself doing so poorly, I'm nervous about trying to get into the stock ahead of the turn. Doesn't help that the balance sheet remains a mess. So for now, I'm keeping an eye on Dave & Buster's, watching, maybe got a potential turn, but at this point, I think it's too early to put money in. Finally, let's talk about the one I really like, and that's called Enersys, which Sam in Pennsylvania asked about back on November 20th. Enersys is really interesting. The company is based in Reading, PA, designs, manufactures, and distributes industrial batteries. It's been around since the late 90s, came public 21 years ago. Over the long run, Enersys has been a great growth stock, climbing up steadily for most of the past 2 decades. But this year in particular, stock's going into overdrive, up roughly 54% year to date. Why? Because Enersys looks to be a big winner from the AI data center theme. Anything that can store electricity is doing big business right now. Now, here's the real exciting thing about Enersys. While the stock's had an excellent run over the past several months, it's still very cheap, trading at just 14 times this year's earnings estimates and 12 times next year's numbers. This company has beaten expectations for 16 consecutive quarters, so I trust these estimates. In fact, when Enersys reported a month ago, that quarter was a thing of beauty. 6% organic sales growth, huge earnings beat. Management also raised its full-year sales and its earnings forecast pretty significantly, and the stock's, well, let's just say it's been on fire ever since. Really, the only negative thing that I can say about Enersys is that you're chasing the stock here. After all, these recent gains, they're in the past. But I feel a lot more comfortable chasing when a stock's at 14 times earnings. So I would actually bless buying some Enersys right here, right now. And then if it drops, you can buy more. And then hope for a market-wide sell-off, nothing having to do with Enersys, and get even bigger. Overall, I think Sam in Pennsylvania has a good one in Enersys. I was pleasantly surprised to find out this was definitely not a year of magical investing stock. Bottom line, I don't really care for this CLSQ or ThreadUp. I'm intrigued by the prospect of Dave & Buster's turn. Not ready to recommend it, though. But Enersys, that looks real good at these levels. That money's back after the break.
Coming up, Cramer takes your calls. And the sky's the limit. It's a fast-fire lightning round. Next.
Let me give you a quick reminder. The special offer is almost over. If you want to follow every market move I make, now's the moment to join my investing club. Don't wait. Scan that QR code or head to cnbc.com/Cramer Club for access to our morning meetings and my charitable trust portfolio. And now it is time. It's time for the lightning round. That's right. We're about both saving the stock that about advice. Also, so don't renew the cost away. That's how my staff bears the graphics of the value. Play this out. And then the lightning round is over. Are you ready? Ski dance on the lightning round. Hey, let's start with Matt in Texas. Matt.
Hey, Jim. Nice to talk to you. I'm just wondering about silver. Should I try Hecla for silver?
Come on, let's stick with the shiny metal. Agnico Eagle was down a couple bucks today. I say. All right, now we're going to Travis in Georgia. Travis.
Booyah, Jim. I'm giving you
Travis.
A call tonight. Booyah.
All right.
Yes, I'm calling about an IPO stock that I got invested in, and now just trying to figure out if I should keep pouring money into it or pull out, and that is Klarna.
I saw the guy on TV today. He made a lot of sense. Sell it and buy a firm. Let's go to Joe in New Jersey. Joe.
Hello, Mr. Cramer.
Hey, Joe. How you doing, partner? What's going on?
I'm doing fine. Nothing much. Getting ready for the holidays. I'm halfway through reading your book, and so far it's fabulous.
Fantastic. Did you get to that part where I talked? Never mind. Thank you, buddy. Come on, Joe. Let's go to work.
Yeah. All right. With analysts raising their price target and off of its highs, is Newmont Corporation a buy?
I like Newmont. Now, I do like Agnico better, but Newmont is real good. And Joe, welcome back. Glad to have you on the show. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer's got a bone to pick with the narrative around the health of the consumer, and he's drawing some conclusions with the holiday shopping season in full swing. Next.
Before I got into money management, I was a journalist. First at the Tallahassee Democrat, and then at the Los Angeles Herald-Examiner. Like Liam Neeson in Taken, that's given me a very particular set of skills. I learned that the editor is always right. So when the editor had an agenda, my word, not hers, you followed it or you risk seeing your story turned on its head, perhaps even killed if you didn't play ball. When you're playing for dinner, my term for when you're writing for dear life, you end up going with the program even if you didn't agree. Now, these days, I don't play for dinner. Haven't in ages, so I can say whatever I want as long as I have researched it and believe it to be true. But the dailies and the wires are staffed with people who have an agenda, including the editors and often the writers themselves. The truth can be an abstraction for some of these people. This matters because right now we're getting a ton of stories about how the consumer's in bad shape. As you can see from recent receipt weakness or stressed balance sheets, credit card defaults, whatever metric they pick. The portrait of the consumer is pitiful, has grave, ominous implications. We obviously need a rate cut, yet the Fed's on the fence about lowering rates. Many companies could be impacted negatively by this top-down analysis. Many investors see this stuff and immediately sell. The retailers and many other things. The problem is, it might not be true. This kind of handiwork is what I call thesis reporting, meaning the writer's got a thesis, the hobbled consumer, and their job is to prove it, even if it means massaging the facts. Why do this? Because negativity sells papers. Unfortunately, this is a false narrative. I could give you hard aggregate numbers like how MasterCard says Black Friday spending was up 4%, more than 4%, which is a reasonable amount, all things considered. I could tell you that credit quality actually is surprisingly good, or I could go company by company, which is really my specialty. Right now, I find that other than Burlington stores, every single retailer that's reported is doing better than expected. In some cases, much better than Kohl's. The resurgence of the department store, with Macy's about to report excellent numbers on top of Kohl's. The ascendance of TJX and Walmart shoppers, now above the $85,000, $100,000 set, akin to Costco's club members, shows a new level of interest that barely existed before. The sizable gains in share price for Best Buy was more than just noteworthy. The strength in the dollar stores is insane when you consider how badly that they've been hit by tariffs. Same goes with Williams-Sonoma, Wayfair, and most notably Gap, which shot the lights out. It's hard to believe that the consumer's in trouble when so many retailers are doing so well, even with the full brunt of the tariffs in effect. So, what are we to make of all this? First, that hobbled consumer thesis, you know what? It's wrong. Even if you consider the spike in buy now, pay later use. Second, let's flip it on its head. Despite tariffs, despite the University of Michigan Consumer Confidence Survey showing negativity, things are actually pretty darn positive. Third, it stands to reason that the consumer's fine, given that jobs are still available and confidence in being employed means more than a survey response. It's very tough to think straight when thesis reporting dominates your head, as well as the nation's trading desk. Think you must, though, because if you base your investments on bad information, you're probably going to lose money. When in doubt, trust the facts, not the theory. I like to say there's always bull market somewhere. I promise I'll find it just for you here, man. Money, I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.